Welcome to this explainer. Today, we're putting on our professional sell-side equity analyst hats to rigorously value AZZ Inc., and we're doing it using just the raw data. If you're the kind of person who loves tearing apart balance sheets and letting the math do the talking, well, you're in exactly the right place. We're going to strip away all that market noise and use strict fundamental valuation models to uncover what this company is actually worth. All right, let's dive straight into this massive number. Our source data indicates AZZ has a staggering 52.13% margin of safety. Now, you know and I know that in the world of equity valuation, finding a mathematically derived margin of safety north of 50%, it's kind of like finding a unicorn. But as rigorous analysts, we don't just blindly take a number at face value, right? Today, we are going to build the financial models step by step to prove exactly how the data gets us there. Here's our analyst toolkit for today. We'll be moving through the sell-side framework, absolute valuation, relative valuation, asset-based models, and finally, we'll deliver our verdict. Section 1, the sell-side framework. Let's build the valuation engine. We're going to stress test AZZ through 3 distinct valuation lenses: absolute, relative, and asset-based. A truly great model relies on triangulating value, So we'll use absolute cash flows to find a baseline, relative multiples to see how it's priced against historical norms, and asset checks to verify structural health. And most importantly, we're going to expertly pivot where our source data demands it. If a model lacks the necessary line items in our dataset, we adapt, just like any professional analyst would on the desk. Moving right along to Section 2, absolute valuation. Let's look at discounting cash and dividends. So a discounted cash flow, or DCF model, is really our bedrock methodology here. At its core, it takes the company's expected future cash generation and figures out exactly what it's worth to an investor right now. We aren't looking at accounting profits here, no. We're looking at cold, hard, unlevered free cash flow. This completely removes the noise and gives us the absolute purest look at actual value creation. Let's process the actual DCF inputs for AZZ. Get this. The company generated a massive $444.67 million in trailing 12-month free cash flow. And even more staggering is the recent growth rate. We're talking an astounding 231.78% free cash flow CAGR over those trailing 12 months. Now, while the exact discount rate isn't itemized in our source documents, applying a standard baseline assumption of a 2 to 3% terminal growth rate, which, let's be honest, is a very sensible default for a mature industrial firm, bridges us straight to a calculated fair value of $395 per share. I mean, the math is incredibly potent here. Now, you might be wondering, why must a rigorous analyst rely on the DCF instead of a dividend discount model for this specific company? I mean, both are totally valid absolute valuation tools, right? But applying the wrong one will completely distort your target price, and ultimately, it's going to misguide your entire investment thesis. Let's process the dividend metrics to understand exactly why. Look at this. Even with a really impressive 17.7% recent dividend growth rate, the current yield is tiny. It's just 0.56%. On top of that, their payout ratio is only 7.56%. What does this tell us? It clearly shows that management is heavily prioritizing internal reinvestment over returning cash directly to shareholders. Because the dividend is such a tiny fraction of their actual cash-generating power, using a DDM here would drastically undervalue the firm. It basically leaves you blind to the company's true worth. So the DCF is absolutely the vastly superior absolute model for evaluating this potential investment. All right, on to Section 3, relative valuation. Time for the peer comparison. So the crucial point here is that we need to see how the stock compares historically against itself in our relative valuation framework. And this brilliantly illustrates the deep discount narrative. AZZ is currently trading at a price-to-earnings ratio of 13.72. Compare that to its own 3-year average PE of 27.32. Literally, it is trading at nearly half of its historical multiple. If you're a value investor, this is the exact type of relative discrepancy you screen for to protect your capital. It's a massive signal. But, as analysts, we have to remain entirely objective. While that PE ratio shows a really steep discount, enterprise and structural multiples tell a slightly different story. For instance, EV to EBITDA is sitting at 13.37, which is actually slightly above its 3-year average of 11.12. Price to sales and price to book are also elevated above their historical averages. So what's the takeaway? It suggests that while bottom line earnings have surged, which is what drove that PE down, the market is actually paying a slight premium for the top-line revenue and the underlying assets right now compared to the recent past. So it's definitely a nuanced picture. Let's move to Section 4, asset-based and structural models. We're navigating the balance sheet. When you're examining the structural bones of a company, a thorough analyst always has to ask, should we break AZZ down segment by segment using a sum of the parts valuation? Or, perhaps calculate a pure liquidation value to find the ultimate absolute floor price? Well, here's where we make the professional analyst's pivot. Without line-by-line balance sheet data and distinct segment reporting in our provided source documents, trying to apply a sum of the parts or liquidation model would require some heavy external guessing, and frankly, that violates our strict valuation rules. So instead, we skip the speculative asset modeling and focus our lens strictly on the concrete health of their capital structure, which our data tracks perfectly. And that capital structure health is perfectly summarized by this single vital metric: a remarkably low debt-to-equity ratio of just 0.37. When debt is this low relative to equity, it basically screams that the balance sheet is incredibly sturdy. But the context makes this even better. Comparing this current 0.37 ratio to its 3-year average of 0.84 proves the company is rapidly deleveraging. I mean, it has more than halved its debt-to-equity footprint. Because their baseline debt risk is collapsing like this, we don't even need to employ a complex adjusted present value or APV model. Quick pro tip for your own modeling: APV is fantastic for companies with highly volatile debt, but AZZ's capital structure is stabilizing beautifully. This entirely validates our reliance on the standard DCF earlier, and it directly lowers the risk profile of your potential investment. And finally, Section 5, the intrinsic value verdict, where momentum meets fundamentals. Take a look at these yearly returns. They illustrate a really clear story. The explosive fundamental growth we just modeled out in our absolute valuation, it hasn't happened in a vacuum. It has been the absolute rocket fuel driving incredible consecutive price momentum out of that 2022 dip. We're seeing massive double-digit gains year after year, right through to the 34.84% return listed for 2026. The fundamentals are actively driving the technical momentum here. Ultimately, value is all about what you yield for the price you pay today, right? And the data shows AZZ currently offers a massive 10.33% free cash flow yield. Alongside a 7.37% earnings yield, this signifies some truly exceptional capital generation efficiency relative to its enterprise pricing. Sure, the dividend yield is tiny, but the underlying engine, it is throwing off an incredible amount of cash. So, bringing it all together, our absolute and relative frameworks anchor us perfectly back to our initial hook. We have a mathematically derived fair value, driven heavily by that massive free cash flow of $300.95. Standing against a current market price of just $144.08, our models completely confirm the data, an implied margin of safety of 52.13%. So, I'm going to leave you with this final thought as you review the outputs of these models. When the objective math is screaming that a stock is trading at a massive discount and the balance sheet health fully supports it, are you brave enough to trust the data over the market? Thanks for joining me in this explainer. Keep questioning the numbers and keep trusting the models.